Ladies and gentlemen, welcome back to our special European edition of our Basel IV channel. In our first part of presenting to you the European banking package, we were focusing on consolidation, capital, MREL, TLAC and credit risk. Now we will move on and have a closer look to FRTB, to disclosure reporting requirements, and of course we will have also an outlook to the strategic implications. But now it's time to move on with market risk, and here we have a special collaboration between a Belgian colleague and a German colleague. We have Guillaume from our Brussels office and Philip from our German office, and as you maybe remember, in the first part of our special European edition of the Basel IV channel we presented the special timeline for FRTB, because that one is really a little bit special and tricky, so don't forget to have a closer look there. And also what I would like to mention is that on European level the new standardized approach, the SBA, the sensitivity-based approach, will be called alternative standardized approach, so don't get confused with that. And the new IMA, the new internal model approach, will be called the alternative IMA. So I would say let's have a closer look. Guillaume, I think you start.
Thank you, Martin. I will give you a brief summary of the change introduced by the CRR II on the market risk capital framework, also known as the fundamental review of the trading book. It has been a long journey since the Basel Committee put the fundamental review of the trading book on the table, leading to a lot of discussion on the banking book trading book boundaries, the new standardized approach, and the new internal model approach. The first change of the fundamental review of the trading book is the revision of the trading book boundary. First, the classification of an instrument depends on the overall treatment of the instrument, such as being accounted at fair value on a daily basis. This classification should then be confirmed by the trading intention of the position. The classification is also complemented by a trading book presumption for specific instruments, such as market making activities or listed equity, for example. This classification is definitely the primary step for the FRTB impact assessment and implementation for all banks. The second change introduced by the fundamental review of the trading book is the new standardized approach. It increases the risk sensitivity of the RWA calculation. It also better reflects the inherent market risk, allowing for diversification benefit and represent a meaningful benchmark across banks. It will also be a fallback for the internal model approach where deemed inappropriate. This approach is based on three components. First component is a sensitivity-based method capturing the linear risk related to the delta and V-gas sensitivities of the trading book position towards a defined set of risk factors and risk weights. The curvature risk charge based on P&L scenario complements this in order to capture curvature risk for nonlinear position. The capital calculation is then the result of a predefined aggregation formula as the largest of three different correlation scenarios. Secondly, the default risk charge aims at capturing the potential loss on the trading book position due to the jump to default of an issuer. And finally, the standardized framework is complemented by a residual risk add-on that captures the risk not covered by the two first components, mainly the risk related to exotic risk factors and complex payoffs. The implementation of the new standards leads to substantial challenges for banks having a large trading book. First of all, the uncertainty in the timeline and the distinction between the reporting and binding capital requirements provokes delays and uncertainty in the implementation project for banks. Secondly, the new standardized approach, designed on sensitivities and P&L scenarios, is significantly more data intensive and complex compared to the current standardized approach, triggering challenges to align and optimize the internal risk management processes. The impact of the new capital charge and trading book boundaries leads to potential adjustment in the product scope, position management, and trading strategies of the banks. Finally, the capital impact and optimization should be reassessed, taking into account the recalibration of the regulatory requirement and the impact of the flow when using the internal model.
Finally, regarding the internal model-based approach under the new FRTB regulation in the EU Trilogue process, there have not been a lot of changes, so most of the approach is still the same as it was with the BCVS paper that came out in 2018. So none of the changes that have been introduced with the new BCVS paper from January 2019 have made their way to the CRR II. The expectation is that they will either be implemented via a delegated regulation act, or they will only find their way into the CRR III when also the capital requirements under the new approaches for market risk will come into force. So what are the main changes with FRTB IMA compared to the current internal models? In the first place, there's a different model approval process. So instead of risk categories, model approvals are now given on a trading desk level. So as long as you have at least 10% of your overall portfolio inside the internal model, you can apply for internal models per trading desk, which also means if certain requirements like backtesting or P&L attribution are not met, also the allowance for internal model use can be withdrawn on an individual trading desk level. Each trading desk needs its clearly defined business strategy and organization. In the final CRR II, there's not the requirements for at least 2 traders anymore, but instead there's a simplification for smaller banks that for small trading desk there can be a personal union in the organizational setup of the desk. For the quantitative requirements, as mentioned before, that's the P&L attribution test and the backtesting exercise now on desk level. And should one of those 2 fail, as mentioned, the desk will be capitalized under the standardized approach. So the bank will need to regularly calculate capital amounts also under the standardized approach in order to have comparable numbers in case of a fallback should one of the 2 tests fail. Widely discussed also in scientific publications, the FRTB IMA will now introduce an expected shortfall risk measure to replace the old value at risk measure to compensate for the generally higher capital numbers. The confidence level has been reduced from 99% to 79.5%. The expected shortfall is solely calibrated to a period of stressed market condition, so there's no 2 components, value at risk and a stressed value at risk like it is in the current environment, but only the expected shortfall measure in a stress environment. Furthermore, capital requirements are increased by additional liquidity horizons for different instrument categories, coming from a 10-day expected shortfall for blue chip liquid equities. Liquidity horizons up to 120 days exist. As a third large change, the incremental risk charge has been replaced by the new default risk charge, which, as the name correctly states, only accounts for default risk and not for migration risk anymore. Thereby, the double counting of migration risk is prevented, as this will also be considered in the expected shortfall in the credit risk especially. For non-model risk factors, there's still a little uncertainty how the exact methodology to calculate capital requirements for non-modelable risk factors should look like. The modelable risk factors, as stated, will be calculated under the expected shortfall. For the non-modelable risk factors, that capital amount shall be based on a stress scenario with very limited diversification, but on the exact methodology how to calculate capital numbers here, we still need to wait on an RTS that shall come out now that the CRR II has been finalized. Additionally, in its January paper, the BCBS has proposed further changes to the non-model risk factor requirements, namely a bucketing approach for the determination whether a risk factor is modelable or non-modelable has been introduced, and we expect that this will be either introduced as said via a delegated regulation over the next 2 years, or in the end with the CRR III coming out before FRTB enters into force as capital requirements.
Guillaume, I have a question regarding the trading book boundary. On the first look, the change does not look so material, but of course the devil is in the detail. What do you think? Will there be a lot of shifts between the banking book and the trading book and vice versa? Does it maybe can happen that banks that currently have no trading book at all will have in the future many trading book exposures?
Thank you, Martin, for raising the question. As you mentioned, the devil lies with the detail, and the answer will depend on the specific position held by the bank. In certain cases, we can expect significant shift of position between the banking book and the trading book. Furthermore, as the shift between the banking book and the trading book will be restricted after the initial allocation, banks should make their preliminary assessment and take any necessary decision in terms of portfolio allocation and strategic product scope prior to the initial allocation. Is there any other question?
Guillaume, I have a question regarding the new standardized approach for market risk and also the alternative approaches that banks can use when they have only small or medium-sized trading book exposures. When you compare the new SBA, the sensitivity-based approach, and the possibility to use still the old standardized approach, for which banks does it actually make sense to use this discretion to use still the old standardized approach and not going to the sensitivity-based approach?
Another very interesting question, Martin. Indeed, the framework foresees the possibility for banks with a limited trading activities to maintain the current calculation framework, enabling them not to implement a more complex and data-intensive calculation process. However, they will not gain the diversification benefit and netting benefit allowed by the new standardized approach. Therefore, I do only expect banks with immaterial trading position to remain under the current framework.
In this video, Hortense from the UK, you are going to present large exposures, liquidity and leverage ratio.
Okay, thank you, Martin. So now we're going to look at the part around liquidity, leverage ratio and large exposures and what the chances are in CRR II. So I'm going to start with liquidity and more specifically NSFR, and now we're going to look at the slides in a bit more detail.
So first, we're going to look at the NSFR, which is the net stable funding ratio. As you can see on the slide, this is calculated by looking at the available stable funding for a bank over the required stable funding, and the ratio needs to be at a minimum level of 100%. So basically what that means is that the objective of the NSFR is to ensure stable funding on an ongoing basis, to reduce the likelihood that disruptions to a bank's regular sources of funding will basically lower its liquidity position in a way that could increase the risk of its failure and potentially lead to broader systemic stress. So compared to the LCR, compared to the liquidity coverage ratio, it's a balance sheet measure. It's not a cash flow measure. It looks at the whole balance sheet and assigns factors to the liability and the asset side to look on the liability side which items provide stable funding, and on the asset side which items need stable funding. And basically, there's this time horizon of 1 year, and if funding is of a maturity of 1 year or above, it's deemed stable. And then again, if assets have a maturity of over 1 year, that they're deemed to require stable funding. So in CRR II, the NSFR, the Basel NSFR is implemented with a few changes compared to the Basel text, but it's obviously implements the NSFR from 2014. The major change compared to the Basel NSFR is the fact that there's a simplified NSFR for small and less complex institutions. And for this, basically, there are criteria to qualify, and they include assets, the size of assets. So if it's under 5 billion euros, if the bank is under no or simplified RRP obligations, if it has a small trading book and derivatives positions that are under 2% of on and off balance sheet items, and if it doesn't use internal models. There are other criteria as well, but those are the key ones. And for the banks that qualify, that it's easier basically to calculate the NSFR and to report, because overall the NSFR will require significant reporting efforts and data gathering, because even if there's a current reporting, the reporting is going to change quite a lot. So that's that for NSFR. And now I'm going to go to the leverage ratio. So as you can see on the right-hand side, the leverage ratio is a non-risk-based capital ratio to basically prevent excessive leverage in the banking sector, and that's came in because of obviously the crisis, and it's been gradually implemented across the world. Again, that's that comes from the Basel text. So when you look at the calculation, it's Tier 1 capital at the top, and then the exposure measure at the bottom, where you have obviously the on-balance sheet and off-balance sheet exposure, and plus derivatives and plus securities financing transactions. And the ratio needs to be over 3%. So the one thing to note, especially for the leverage ratio in CRR II, is that there are some exclusions from the exposure measures, such as exposure against central banks, clearing members, QCCPs, pass-through loans, and certain promotional loans. So that's a key difference with Basel. There's also an adjusted leverage ratio to be complied with if the exceptions for central bank's exposure are being used. One other point to note is the fact that for the derivatives, to calculate the exposure value, firms need to use the modified standardized approach to counterparty credit risk. And then maybe one last thing that is worth pointing out is the fact that in terms of reporting, there is the introduction of some proportionality, meaning that small and less complex institutions have reduced reporting and disclosure requirements. But on the other hand, for large institutions, there's more to make sure that there's no window dressing behavior, especially around end of period versus average ratio. So the last thing that I wanted to cover, which is also quite important because there are quite a few changes, is the large exposure framework. So I mean, obviously the large exposure framework has been in place for quite a while, but CRR II introduces changes to the requirement itself and the way the exposure is calculated. So if you look at the slides, again you see at the top the way the large exposure itself is calculated, and then at the bottom it's obviously the capital, and the requirement is to have that is the fact that the large exposure shouldn't be over 25%. So the key changes there are, on the denominator, in the sense that, it's more restrictive, meaning that it's only Tier 1 capital, so no more Tier 2 capital allowable there. And then on the calculation of the exposure, so obviously you look at the balance sheet assets, and then obviously the off-balance sheets where you need to apply the SICCR or the EOM, again, for the calculation of derivatives. And then you get to, a gross exposure in a way, but then you can apply, credit risk mitigation. And there, if you apply those for, your capital risk-based capital ratio, you need to use the same ones for the large exposure. And then there are some exemptions, but it's worth noting that there's a tightening around exemption in CRR II. So, for instance, the gradual elimination of exemptions for exposures to EU central governments that are neither in euro or EU national currency by 2022. And then so you get to after that you get to a net exposure, and as I said, it needs to be under 25%. But obviously a key change also there as well is the fact that for exposures between GSI, so global systemically important institution, the limit is lowered to 15% of Tier 1 capital. So that's a key change in CRR II. The other thing worth maybe mentioning is the fact that there's additional reporting, and for instance the reporting of the top 10 exposures to shadow banks.
Thank you. That's it for now. And now back to you, Martin, with any questions that you might have.
Thank you very much for your presentation. It was really interesting. We have an additional question regarding liquidity. The NSFR is already known since 2010 on Basel level. It's already a reporting requirement in the EU since 2014. Do you think that the NSFR, the implementation and meeting the 100% is still a challenge for banks in the EU?
So on the impact of NSFR, I would say that the banks that are going to be most impacted are the ones that are mostly funded by short-term wholesale funding, because they will have to lengthen the maturity of their funding. So it would be mostly investment banks in that context rather than retail banks, and especially the ones that have significant derivatives portfolio or repo transactions as well. But beyond that, I would say that for all banks, the data ask for the new reporting is going to be significant, because it's true that currently banks have to report on correct forms on NSFR, but those forms are completely outdated and you can't really calculate the NSFR from those. So the new forms are going to be, require significant implementation efforts from most banks.
Also one question regarding large exposures. The definition of the large exposure limit is now new in the CRR II. It's only one side of the coin. There are also some requirements regarding building or defining the group of connected clients. There are new EBA guidelines that must be considered. Can you maybe summarize the major challenges and what are the interactions to the rest of the large exposure rules in the CRR II?
So yeah, good question here in terms of connected clients, because obviously the large exposure requirement applies to a single counterparty or a group of connected clients. And on that front, the EBA issued new guidelines at the end of 2017, on connected clients, and those guidelines apply from the 1st of January of this year, 2019. So those guidelines give more detail around, the notion of control when you can't really rely on, the financial statement and the accounting, situation, and basically it gives a list of criteria to establish, whether there's a situation of control from one counterparty on another, and then also around economic dependency. So when, one counterparty's financial or funding difficulties could, have a material impact on another one. And again, here it gives a list of situations that would qualify as economic dependencies. And then there's also more, detail around, the situations where control and economic dependencies are intertwined. So obviously those guidelines are really important to basically apply the new large exposure requirement.
One topic that we should definitely not forget is disclosure, the Pillar 3 requirements of the Basel framework. Stefan, could you give us an overview about Pillar 3?
And finally, let's have a look at the changes to reporting and disclosure requirements. Obviously, whenever the regulator decides to change something, he also adapts the reporting and disclosure requirements to take account of these changes. Looking at regulatory reporting first, here the most important change is the introduction of additional elements of proportionality, and the EBA will be tasked to produce some suggestions on how to reduce the reporting burden for so-called small and non-complex institutions, which are institutions with total assets below 5 billion euros, no internal models, small trading book, and other requirements. Both the frequency as well as the amount of reporting might be reduced for these institutions. There are additional reporting requirements for resolution units, and finally, as has already been said with regard to the FRTB, there will be a requirement to report on the new FRTB approaches even before they become binding Pillar 1 minimum capital requirements. Next to reporting, also the disclosure requirements are being overhauled and aligned to the recent Basel initiatives. This means that on the one hand side, there are new requirements, for example, the introduction of the key prudential metrics template, which offers an overview of the most important ratios. There are new disclosure requirements with regards to TLAC, and also the disclosure of liquidity ratios and risk management will be included in the CRR, even though it has only been an EBA guideline so far. Finally, the EBA is tasked to develop uniform disclosure formats that take account of the recent Basel papers. Besides those new requirements, there are also enhanced disclosure requirements. Let's have a look at the most important ones. First of all, obviously, the introduction of the SACCR necessitates the introduction of new disclosure requirements which take account of the new approaches to calculate the EAD for derivatives. The same is true for the FRTB, so the market risk rules, which also make necessary revised disclosure requirements for market risk. And finally, the securitization framework, which is already in force since the beginning of 2019, is now reflected in new and revised disclosure requirements. Altogether, these requirements will lead to additional data requirements and make it more important for institutions to have sufficient processes in place to produce on a quarterly basis their disclosure reports, taking account once again of the topic of proportionality, which gives now clear indications on the amount and frequency of disclosures, depending on the one hand side on the size of the institution, as well as the fact of whether it is capital market oriented or not.
Thanks, Stefan. I have another question regarding disclosure. There were already a lot of changes in the recent years regarding disclosure, especially coming from the EBA guidelines on disclosure. What do you think? The changes that we see now in the CRR, are they more small adjustments to the existing disclosure regime, or are they completely new challenges?
Once again, both is true to some extent. On the one hand side, there is clearly changes that have been adopted from the EBA guidelines, like for example, the disclosure of liquidity risk. But on the other hand side, there are also completely new requirements to disclose, for example, the key metrics templates that has been proposed by the Basel Committee.
So far we were discussing especially the challenges for the implementation, but there are of course also strategic challenges. And here I'm very happy to welcome Philip, our strategy expert when it comes to changes in the regulatory framework. Philip, it's your turn.
So, as we've learned before, Basel IV brings enormous challenges on the implementation sides to banks, but there are also a number of strategic implications. And first and foremost, there's the question whether the traditional banking business model of a largely interest rate and interest business driven business model with a buy and hold strategy for loans is still valid or not. When we look into strategic implications, we look into what kind of product portfolio does in the age of Basel IV still make sense, which product portfolio is still affordable, and what kind of assets can I still have on my balance sheet until maturity. And when we talk to banks and we are discussing about strategic implications, we have crystallized three potential way forward out for banks to cope with the challenges Basel IV bring to the table. What you see on the summary of those strategic imperatives on the left-hand side, the first one being a less intensive balance sheet usage. This is one of the key components where ideally banks need to think about how to reduce deployment of its own balance sheet for existing business and potentially grow new business in a more capital efficient way, in a balance sheet light way, e.g. by introducing originate to distribute 2.0 models, structure to sell, and similar solutions. It's not the old-fashioned model from pre-crisis time. It needs to be a smarter way of doing this. And there are multiple ways how to do this, and we can elaborate this in more detail later on. The second one is obviously related to that, the disintegration of the bank value chain. It's very important in that context to reduce the cost structure and increase margins by just lowering the intensity of the bank value chain by engaging in utilities with other players, by reconsidering the outsourcing component and focusing really on what makes a competitive advantage in the marketplace, those capabilities where the bank clearly has a right to win, while for all the other capabilities, partners need to be found. The third one being full employment of digital technologies, and everybody is talking about this a lot, but in order to make this happen and to leverage the first two imperatives mentioned before, it really needs to be done in a consistent and comprehensive manner. And this is basically what is then displayed on the right-hand side, where the future business model is moving from a, let's say, business model with high balance sheet intensity, buy and hold of loans, and a very low, let's say, disintegration of the value chain. So this is what is going to change. And I think this is how many leading banks have picked the topic up so far. This can also be illustrated in the income statement and or P&L structure of a bank. On the left-hand side, you see the traditional bank business model with a large share of income generated through loans, interest income. And on the right-hand side, this is moving to a model where interest rate income is basically converted into fee income. It's not the old-fashioned discussion about banks need to increase their fee income in times of low interest rates. It's a different composition structurally of the P&L and where the income is generated. And what we mean here is actually a conversion of interest income into fee income by capturing more fees in the lending value chain, packaging deals, structuring deals, originating deals as a core capability, but also once packaged, exiting partially or entirely over the lifetime or immediately, parts or the entire loan straight away. And with that structure, you can compensate some of the top line decrease by an increase of the bottom line of the individual business, thus potentially reducing the overall revenue base of the bank, but substantially increasing the profitability. And this is basically what it is all about on a higher level, how the strategic key reactions on the Basel IV changes will affect banks. We obviously have a lot more in detail on how individual or capital should be deployed on individual asset classes, on individual products, and so on, how the composition of the business mix is going to change. But this will all need to happen in line with this, what we mentioned here around the balance sheet lighter business model. So these were the key topics on the strategic implications for banks. Thank you very much for your attention.
Thank you very much, Philip, for this very interesting presentation. Banks very often refer, when they speak about the CRR II, about the first part of Basel IV. What is your advice? Should banks see it more as two separate topics, or is it simply two sides of the same coin? What is your advice?
It's actually a very good question, Martin, and I think banks need to look at this in an integrated way. It's not a different challenge, it's part of a greater challenge in general, CRR II and Basel IV. And before you implement the entire thing straight away, it's very important to also look at the strategic implications those new regulations will have and how they will impact the individual financial institution, because every institution is affected differently, and that's what you need to take into consideration.
Thanks, Philip. I have another question, of course. We heard today a lot about the implementation challenges of Basel IV, but you are our strategy expert. Does the banking package also implies strategic challenges for our clients?
Yes, obviously, and as we said before, there's clearly also a very huge strategic challenge with that new regulation coming into place. And first and foremost is to properly understand what's the individual impact on your business portfolio, how are the individual asset classes and products affected, what drives RWA up and what potentially keeps RWA low. This also changes the composition of your business mix. Once that is understood, you need to draw the right conclusion as a financial institution in where to invest your capital and how your product profitability and how your business mix looks afterwards. So it's very important before implementing the entire regulation to smartly think about how the business is affected, how do you need to change the composition, and then make the right decisions on the implementation afterwards.
So far, with the strategic implications of the new banking package, but of course, apart from these strategic challenges, there are also a number of implementation challenges that the banks should consider. And here, of course, we can learn from the past. I mean, here, especially the implementation of Basel II and Basel III. So what are the most important lessons learned from these big implementations? First of all, with regard to leadership and the engagement, I think it's very important to include directly from the beginning the senior leadership into these kind of projects. And when we are speaking here about senior leadership or senior management, it is important that the implementation of the banking packages will consider topics that must be considered by the business,
lines itself, by the risk management departments, the IT departments, operations, and of course, last but not least, also finance. And we need a good governance in these kind of projects. That's why it's very important to have a steering committee that is proactive and that is getting on-time reports from the project management team to be able to make the important decisions and to guide the project. Communication, of course, is also very important, especially when we are speaking about so complex technical requirements like what we have in the CRR II, in the BRRD II, in the SRMR. That's why it's very important to speak and to enforce communication between all the departments that are involved. I was mentioning before the business departments, risk management, IT, and finance. These participants in this project have to communicate on a constant basis. And also what is very important is to have a good training of all people that are involved in these kind of projects so that they really actually know what they have to implement. Especially when we speak about the departments that are not so close to these topics. It's like, of course, in the risk management departments and the finance departments, people are going to be quite familiar with these topics, but especially when we speak about IT and also the business areas, it's very important to give them good insight and a good understanding. Yeah, of course, when we are speaking here about the implementation of regulatory requirements, compliance is very, very important, but we also have to consider that banks have to optimize their implementation, not only from the project plan on, but also on how they implement these regulatory requirements. And it's very important to have a sound understanding on how these regulatory requirements will affect the business, and then trying to seek a balance between 100% compliance and the optimization in the implementation. Impact gaps and owners. Also here, it's very important to start with an analysis of actually where the bank still has gaps, and then trying to set up a very, very a very structured approach on how to close these gaps. And this gap analysis should not be performed only in the beginning of these projects. It should be also performed in between, simply to have a good understanding where we are actually standing. Last but not least, what I would like to mention, also a very important lessons learned, these projects where banks have to implement regulatory requirements are not the only projects in the banks. A lot of banks are currently renewing their IT infrastructure. They're thinking about revised business models, actually on how to generate profits. It's very important that these big regulatory requirement implementation projects are aligned with all other big projects and programs in the bank, simply to identify points where you can achieve synergies and to save costs in the implementation. I would like to give you one quick example how these kind of regulatory implementation projects can be set up. Here in the beginning, I would like to mention that it's also very important, like Philip was mentioning before, not to look to the banking package alone. You always have to have in mind that there will be some additional requirements under the headline of Basel IV, especially when we are speaking about the new standardized approach for credit risk, when we speak about the new IRB approach, when we speak about operational risk, CVA, and some smaller topics. In the end, it's all about risk-weighted assets, calculation of risk-weighted assets, and it's important to look to these huge challenges in the future as one big project and to align it. It makes no sense from my perspective to set up one CRR II project now and in 1 year a separate Basel IV project. I think the topics are so strongly interconnected and depending on each other that it's important to set up one big overall Basel IV program. That's how you could call it. And here you see the structure. As I was mentioning before, the lessons learned, communication is very important, and also training. That's the first work stream in this project structure, simply to assure that all required people are on the same page and speak about the same requirements. Then, of course, we speak about 9 different work streams that are going to implement the new regulatory requirements, credit risk, which will be divided in standardized approach, IRB, and SACCR. We have operational risk, securitization, disclosure, CVA, FRTB, of course, very important work stream here. We have liquidity and leverage ratio as one work stream. And last but not least, we have MREL and TLAC. And of course, there are some topics that must be considered in all work stream, especially the quantification of the capital impact. What are the impacts on the strategy of a bank, on the business model of a bank? It's important to look to the governance of all these work streams, that it's harmonized, and in the end, that the overall Basel IV program is aggregates all these challenges up to achieve a good governance. Policies have to be written, IT and data, of course. All these new requirements must be implemented, and it must be implemented in a sound way so that the IT is performing and that the data quality is good. And last but not least, also what I would like to mention here on the right-hand side of this slide, the business units must be involved. It makes no sense to set up a regulatory requirement project without including the business. Also, the strategy of the bank, as I was mentioning before, must be included. And for banks that are operating as a group, all subsidiaries should be involved directly from the beginning. Because it's such a big regulatory implementation project, we always say that it should be a program. Therefore, you need a program lead, a project manager, or a team of project managers that is putting all together, that is supported by a project management office. A technical committee might be very good to set it up, because we are speaking here about quite complex regulatory requirements. So to have some very good technical experts on board that are advising the project lead is very important. And a steering committee should be set up that consists of all involved departments. Here to mention again, risk, finance, the business, and operations. And when we speak about the sponsoring organization, of course, you could always argue who is in the end responsible. Is it the CFO or is it the CRO? I personally think when we're speaking about a Basel IV program or a CRR II program, it should be a combination, and both CFO and CRO should have the role as a sponsor and it's also giving advice to these to this big regulatory requirement implementation project.
Ladies and gentlemen, that was our short presentation regarding the major challenges of the European banking packages. I hope you enjoyed it, and I hope we were able to show to you that the new requirements coming from the CRR II, the BRRD and the SRMR are really huge challenges for the next years for the banks to implement it, but also for the business model. I personally say the time until these new requirements have to be applied by the banks is not so long anymore. It will be in the beginning of 2021 or in the mid of 2021. So banks should definitely start now in preparing for these new regulatory requirements and set up their projects. And even more important, as we heard from Philip here, you have to consider also the connections regarding the rest of Basel IV, especially when it comes to the new standardized approach for credit risk, IRB approach, and CVA. So again, thank you very much to all the speakers for today, all my international colleagues, and thank you very much for listening, and I hope to see you soon again. Bye.
Well, thank you for joining. I've explained to you quite of course in a nutshell, the changes around the equity investments in funds and the changes in the securitization framework in the CRR, the CRR II. I hope you this was valuable. Thank you for joining, and hope to see you soon again in person. Thank you. Bye from Amsterdam.
And that's it from me, so thank you very much for your attention.
Wishing you all a great CRR II journey. Greetings from Brussels.
Thank you. It's been a great pleasure talking to you about the CRR II. Goodbye, or as we say in Germany, ciao with V.
Thank you very much for your interest. Please feel free to reach out in case you have any questions, want to discuss it. Take the right decisions also strategically and then implement it right away.